Hi, everyone. We'll be getting started shortly. In the meantime, we'd love to see where you're coming from. So please write in the chat where you're from and also what business you're in. As you see people writing, you can write something along the lines of, hey, Jane from Sydney, Bob from Melbourne. So yeah, let's get it started in the chat. Awesome.
Awesome.
Nice to see you all.
All over. A few East Coasters.
What's this, sorry?
I said, yeah, a few people from up and down the East Coast.
Yeah, we love to see it. Awesome, guys. All right. Well, hi, everyone. I hope you're all doing well and you're ready for an engaging session with Julian Fayad. I'm Kirsten from the Boa Events team, and we're thrilled to have you all here. With me on the call today is Laura and Beck from the Boa team. Before we get started, here are some important points. Please keep your microphones muted to minimize background noise. Use the chat for questions and comments. And this session is being recorded for later viewing. The session will run for about 40 minutes, followed by Q&A. If you encounter any technical issues, message our team in the chat for any assistance. And if you missed our alerts, we've just rolled out a new version of the app, version 1.7.5, and with it comes new communities and events that you can attend in person and virtually. So be sure to check that out on the latest version. Okay, so now let's get ready to meet the star of the hour, Julian Fayad. Julian is the founder and CEO of LoanOptions.ai, Australia's first AI-powered loan marketplace, which compares all the best loan offers from over 70+ lenders and allows clients and small businesses to apply in under 7 minutes with no impact to their credit score. Today, Julian is going to show you how to close your cash flow gaps, how to draw funds against assets with your business, and how to navigate all the different lending products. Please give a warm welcome to Julian. So thanks, Julian. Over to you.
Thank you so much. That was quite the introduction. And I'm very grateful to be here and kind of walk through some of the, I guess, the different options that you can use to avoid having to dilute or sell equity or in your business and I guess close that cash flow gap. So from my perspective, obviously I'm a small business owner myself, and I was looking at what sort of resources are available out there. There's not a lot of education on the different products, and so I thought this would be a good way to share that with everybody. And if you're wondering why I'm dressed like this, no, I don't dress like this every day. It is for Halloween. For those of you who follow our business, we do the last day of the month, we do a dress up theme in our office, and it happens to be Halloween. So but yeah, I'll kick off and just want to start with talking about the problem. So typically there's a few different reasons, and you need capital whether you want to scale or expand or invest in technology to kind of make your operation more efficient, but you don't necessarily want to give up equity yet or at all. And you may not want to give up equity yet because you think you're selling yourself short. It hasn't realized enough of its value or potential yet, and giving up some equity at this point in time would mean that you in the long term are selling yourself short. You may not want to give up control, or maybe you haven't found the right partner. You don't want another chef in the kitchen. You don't want the extra red tape, especially in early days. We know that red tape can kill innovation. And maybe it's not the right timing from an investment environment, or just the macro outlook on the capital markets at the moment isn't the greatest. And then maybe you're not DD ready, and there's some great resources available through Boa that some great speakers coming up, and I suggest you attend them because they'll help you get prepared for making your business I guess more due diligence ready. So the next, dealing with the problem, navigating the space can be a nightmare. It's there's so many different lenders, so many different products, so many different brokers, so many different everything. It's quite the rabbit hole that you can go and almost nobody gets it right the first time. So if you have had some issues in the past with a broker or a funder or whatever it might be, you're not the first person. You certainly won't be the last person. There's a number of different solutions. I think, before you even talk about a loan or loan products, there's other options that you should consider. Think decisions that you can make in the business that will help. So if there's a way for you to close your cash flow gap just by changing your terms, or providing discounts for people who pay immediately and upfront, that will help you. And so this isn't just about loan products, it's about things like R&D, tax grants, incentives, government grants that you should be exploring. And there's no right answer. Every business and every director has their own kind of risk appetite and their own willingness for debt or any kind of risk, really. So R&D tax grants, we recently lodged ours for the previous financial year. I strongly recommend you deal with an expert there. Don't try and do that stuff yourself. Navigating it yourself will be a cheaper option. However, it will take you a lot of your own time preparing the R&D claim, and you'll likely end up with less money than if you engaged a professional who knows how to maximize your claim, helps you prevent getting audited, and of course, they'll charge a fee, but usually if you deal with the right people, the fees are extremely reasonable. And that means that they'll handle most of the claim. You can give them access to your Xero MYB accounting package, and they can go in and do all the digging and ask you questions when they need to. That will fast track the process quite substantially. So bank loans, I kind of group that into traditional lending or using legacy loan products. You've got fintech and non-banks. They're obviously rising. They're becoming more and more popular, and the more popular they become, the more competitively priced they can become. And that's more outside the box lending, usually based on your business's revenue. There's invoice or debtor finance. There's equipment equity releases, also known as sale and buyback. E-commerce and SaaS specific products. So there's companies that can lend against future SaaS revenue. Companies that can lend for e-commerce marketing budgets. As soon as you can demonstrate an ROI, they'll basically unlock a lot of funding for you to use for marketing and other purposes as well. And then you've got buy now, pay laters for businesses and other types of corporate cards. There are also venture loans. So this is for someone who thinks that at some point they will be ready for a VC or another type of capital market. A venture loan is a great way to dip your toe in the water. It's a facility, and we'll get to it, but it's a facility where you won't have to dilute or give up equity, but you're effectively going through a light version of the DD that a VC would put you through. And it's about building a relationship with particular, let's say like One Ventures is an example. One Ventures is a VC firm, but they have this venture loan product. And it's designed to let people dip their toe in and see if it's a good fit and see if they can kick the goals that they say they're going to kick. And then obviously they'll take an equity position at a later stage if you decide that it's a good fit. But there's no obligation to continue down that path. So some other examples would be obviously looking at your profit margins and assessing whether changes can be made there. Looking at the channels and channel strategy, are some channels costing you money? Is that causing the cash flow gap? Is that causing the cash flow pinch even? But if you can find the sales or the channels that allow you to convert your sales into cash much faster, that will obviously help relieve some of the pain. I'll start with R&D incentives and other government grants. It's not debt, therefore, obviously, some of the pros are it's not debt, it's no interest and no repayments. It's payable as a cash rebate after tax returns are lodged, and depending on whether you're registering a profit or a loss overall, you could get back up to 43.5% of eligible R&D costs. And the cons are it's not the fastest way to get money. Typically that process can be 3 months or so. depending on who your consultant is. There's also, a couple of weeks after it's all lodged and, for you to actually get the money. And obviously there's a risk of audit, as with any grant. It is probably one of the easier grants if you qualify to get, because you more or less it's a self-assessment, and as long as you're not making extremely outrageous claims, it's relatively easy process. So that's obviously a good way to get money back, and it's like I said, no interest, and you're not giving away equity. So cost of funds, obviously, the summary is that's a 10 out of 10. Ease of approval, I give that a 6 out of 10. It's probably similar to that of like a bank legacy financial institution loan. It's kind of, we need your financials, we need, all your bits and pieces, and you need to, do timesheets for your staff. And, so it's not the easiest way to get funds. It can be revolving, albeit it won't be an unlimited time, like a real revolving facility. You do need to reapply every year. And in terms of documents that you need to provide, that gets a 3 out of 10. It's probably the most, whilst it's the best in some areas, given cost of funds is 0, the documents required is definitely probably the most tedious of any of the subsequent products. There's no need for a director's guarantee. It's not secured or anything against any of your business, because it's not a loan. And is it startup friendly? Absolutely. In fact, it's probably more aimed at startups than anything else. You need to prove that you've got a product. You need to be able to demonstrate that you did research to show that there was no product like the one you're building. And so that's kind of the summary of the R&D. Bank loans and traditional assessment. So here, some of the pros are, typically with the scale of a big bank, you do get, quite competitive pricing. You get the familiarity and the social proof that comes with a bank, in terms of the industry being highly regulated. And you obviously can leverage existing relationships or a branch network if that's important to you. And it can be, connected to your business banking, which obviously is a nice little addition there. Cons, really slow, comparatively to the rest of the market. Banks are, really slow. They're known for being inside the box thinkers. They have a certain box that they want you to fit in, and it's not necessarily startup or entrepreneur friendly. A lot of businesses that come to us, they've been to a bank and they haven't had success. And one of the reasons is, entrepreneurs do try, they do go down the path of aggressive growth, which usually leaves not a lot of, bottom line profitability, which is what banks want to see: strong balance sheet, strong profitability, which, translates into more, stronger balance sheet over time. There's obviously a lower likelihood of approval unless you fit inside the box, which is one of the cons. And like I said, slow and they take long. They usually offer term loans, overdraft facilities, lines of credit. The one thing that you need to, I guess, be super careful of with bank business loans is that they'll typically take out a GSA, PMSI, or an all-PAP, which an all-PAP is all present and after acquired property. It's a security against the entire business. And it's not something we recommend you doing. Basically what it does is it gives the bank all authority and title over any equipment you acquire in the business. So if something does go wrong, they can basically come and take your trucks, your equipment, all that kind of stuff. They have title over that. And that's what the all-PAP is. Cost of funds is one of the better ones, obviously. Not as good as R&D, which is somewhat free, but still one of the more competitive. Ease of approval, 6 out of 10. It's probably similar in terms of that approval process to an R&D claim. They do have revolving facilities, documents required. It's a little bit better than an R&D claim. Directors' guarantees are required. It can be secured or unsecured. Usually secured. If it's going to be an unsecured, say a business loan, they'll typically take the all-PAP, as I mentioned. That's why I've got the asterisks there. And they're not very friendly for startups. So that's a key thing that I should point out. For sort of fintech or a blend between finance and technology, those sort of new to market neo banks, neo lenders, all the kind of disruptors of the market, as well as non-banks. They do more revenue-based lending. So some of the pros are the pricing is fair. It's not as competitive as a bank loan usually. In some cases, it can be more competitive, but if you just took an average of the sample size, it would be more often than not a little bit more expensive. But the process is digital. It's a really, really fast turnaround time. We often are able to get funding for businesses through this style of lending product in 24 hours or less. It's quite a bit more startup friendly. You don't need to have your financials in order. Essentially, the credit assessment is based on the business's revenue, which they just get a scrape of the. You basically just log into your bank account, and they get a file that shows what your revenue is, what your expenses are. So decisioning can be next to instantaneous, and it can be connected to your business banking as well, and pushed straight into your account. Cons already kind of covered that. If your revenue is high enough, then it can actually be cheaper than the bank, because banks want a very specific type of client. They price for that specific type of client. They kind of leave the people that are on sort of just outside that little box. They're not priced that competitively compared to what you can get with one of these types of facilities. There's also different products, that you can get. Obviously, you can get the term loan, the overdraft facility, lines of credit. You can also get things like a merchant cash advance. So if you've got a merchant facility that's, and you're not seeing the funds for a few days, you can actually, get access to those funds, from the daily takings, instantaneously. So there's a few more products. I can't go into all of them right now, but there's quite a few more products that you can get through these kind of innovative disruptor style lending products. Process is really just, ID, you sign a consent form, give your ABN details, and, connect your bank accounts. And that's pretty much the process for an approval. Cost of funds, not as good as the banks, as we said. Ease of approvals, 10 out of 10. Pretty much as easy as you can get. Revolving facilities are available. Documents required, 10 out of 10, in terms of not having to provide much. Directors' guarantees are required. And there is options for both secured and unsecured loans or loan facilities. Secured is typically tied to equipment or other goods that have serial numbers that you can actually securitize. Unsecured is probably the most common option in business lending, because that gives you the freedom and flexibility to spend it on whatever you wish. It also means that none of your other assets are tied to the loan. Startup funding, yeah, typically you would want a business that's trading 3 to 6 months before they would look at it. If you're not careful and you don't speak to the right person for this, you could get some of those products have termination costs unless you negotiate your way around them, or unless you've got a broker in your corner that's actually looking out for your best interest. So those are some of the things to watch out with these types of products. Invoice and debtor financing. This is particularly helpful for those that have longer payment cycles or get paid, really slow from their providers. Yes, we can service the construction industry. That's a big one, and we kind of see that as probably the most challenging industry at the moment. The pros of invoice or debtor financing. Construction I'll put into a separate category, because typically construction is higher risk, therefore it's a little bit more expensive, but every other industry, more or less, this is one of the most competitive ways you can access your own funds. It's not a loan product per se. Effectively, they're using your receivables ledger in your business, your accounts receivable, as security. So they'll forward you or advance you the money until you actually get paid that invoice. And then they take a very small percentage of that invoice as their fee. So it's not interest that you're paying, it's more or less a fee. It's quite startup friendly. It can be connected directly to Xero, MYOB, QuickBooks, and other accounting packages, so that from a digital perspective, you can just go in, upload the most recent invoice that you would like to unlock funds on, or you can just get all of your invoices unlocked. And most of them will allow you to draw anywhere between 80 and 99% of your invoice value. So there's some limitations on the types of invoices. So obviously it can't just be your mate's business that's invoicing you. They do some due diligence on the supplier, and it's a bit more restrictive than just getting the money into your account. So there's some protections in place for the funder, but more or less it's one of the cheapest ways that you can close cash flow gaps. There's some case studies that I'll talk about a little bit later. And this sort of facility can really get you out of trouble. If you need to pay it, rather than be late on an ATO bill or a really important account of yours, unlock the money, pay what you need, and then obviously when you actually receive the funds, they'll take their clip, and the rest of it's yours. Ease of approval, 9 out of 10. I want to say that that's probably gotten a little bit harder. It's probably a little more stringency. So probably I would say normally it's a 9 out of 10. This process right now, just with the way the market is, probably I would downgrade that temporarily to probably a 7 out of 10. But hopefully, when the sentiment is a little bit better out there in the market, especially around construction, I think that will come back to a 9 out of 10. Documents required, 10 out of 10. More or less, they can deal directly with your accountant, is why I put that. They can get access to your, Xero, MYB, read-only access, of course, and they can kind of do all the DD themselves and, leave you alone, make the process quite simple. This is a secured type facility. It's secured against your receivables ledger. So again, you're not tying up your residential property. The one thing that I see a lot of bad decisions made is directors of businesses allow banks to take security over their residential property. They allow banks to take security over their entire business, when in reality there should just be the least amount of security provided, just in case things do go bad. Brokers also have in the past, I've seen clients come through to us, brokers have in the past recommended a product that uses, the property, the home that's housing their husband, wife, kids, as security. And we know that business, especially in the last few years, we know how, kind of volatile the market can be. We know that, any business that may seem on face value to be very viable, it only takes, a pandemic or another lockdown or something like that to make it completely unviable. And therefore, your personal assets that you've worked so hard over the years to build up, could get called upon, and it's just not something that we would recommend. It's obviously an option, but it's not something we would jump to the idea of recommending as a first or a second or a third option. To be totally honest, it's probably the last resort if you've got no other choice and you really need access. Then and only then should you consider using your personal assets as security. So pretty much what to watch for with this type of product is invoices for the goods and services. You just got to make sure they're acceptable, and most industries can be accepted. There's some exceptions, but yeah, just got to make sure that's a part we can help you identify. So this is a case study specifically for invoice or debtor finance. It was a butcher or a wholesale meat business, and the problem, which is a good one, is that Woolworths placed an extremely large order, like literally tons of meat from them, and they pay on 90 days in arrears terms. So from a cash flow perspective, the meat wholesaler was going to struggle and have to front the capital to bring in the additional product and meat. They're worried it might actually bankrupt them due to the increase in their costs in the short term. So for them to actually fulfill the order and acquire the equipment to fulfill the order and all the product to fulfill the order, they just didn't have that level of cash. But it was, they needed to find a way to solve it, because this is obviously a very big contract for them, and the ability to do future business with Woolworths and potentially other supermarkets as well. The invoice and debtor finance facility allowed them to access the funds early from the Woolworths invoice. Woolworths were none the wiser in this situation, and the lending facility was secured only against the receivables ledger. The cost was only around 0.5 to 1% of the invoice value for that specific scenario. So let's say it was a 100,000 plus invoice, or maybe it was a few 100,000 invoice. That it doesn't really matter. The point is, let's say it was 1% in this scenario. That was the cost of accessing those funds early. So it's a really easy and cheap way for them to get out of it. And once the first payment was made by Woolies, then obviously they could continue to use the facility if they needed it, but more or less they had the funds come in, and they could use those funds that have come in to sustain future large orders like that. So this is one that's not really talked about a lot, and I think personally it's one of the best overall products that you can use if it's applicable. So this equipment equity release, it's called many different things: sale and buyback, sale and leaseback, capital raising, whatever you want to call it. But the concept is the same. You might already own assets that are owned outright. So maybe you purchased a ute or a truck or a piece of equipment and you paid cash for it at the time because cash flow was really good, really strong at that time. And now there's a bit of a pinch, and or maybe you want to raise more capital so that you don't have to sell equity in your business. So you can go to all the assets in your business, anything that basically has a serial number. So that could be, even if, for example, a CNC machine, or, it could be an excavator, or it could be office equipment. It could be really almost anything. And we can raise funds against that particular asset. So let's say it's a ute, as an example. You own the ute outright. That's really easy. We can do a desktop valuation on the ute and say, okay, the ute's worth $60,000. We're prepared to lend you, up to 120% of the loan to value ratio. So we might be able to lend the full amount, or we might actually be able to lend more than the full amount. And that is going to be a really competitively priced product, because it is using equipment as security. Some lenders have limitations on how long ago you could have purchased. Some are unlimited. So some lenders will say, I'll only let you fund it or raise capital against it if you've purchased it in the last 3 or 6 or 12 months. Some lenders have no limitations there. So it's, again, it's all about having the right contacts. And some assets and equipment may not be eligible to secure against. So if it's a, let's put it, there's usually assets are classed in 3 different ways. They're a primary asset, which is not all the time, but most of the time it's wheeled assets and equipment. That's a primary asset. And then you have a secondary assets, which are probably, things that you find in manufacturing, things that you find in, most of them fall into those 2 categories. But the third category is tertiary assets. Tertiary assets might be things like IT equipment, might be things like beauty equipment, like laser hair removal machines and other bits and pieces. So some of those assets you won't be able to use as security, but that's a very small percentage. Anything that effectively we can get a valuation on, and not necessarily the same level of due diligence that you would do on a property valuation, but more a desktop style valuation where they can do some research online and find out there's a secondary market. Once they can establish the value, they can lend money against it and use it as security. So we see that quite a lot with businesses that have purchased a lot of trucks and equipment and outright, or maybe they did finance it, but they've paid it off, and now they want to draw money against it again. It's a really cost-effective way for you to access the approvals process. Quite easy. It's not a revolving facility, so typically you would take out a 5-year term on a piece of equipment. You could do up to 7 years. You could do less. You could do anything greater than 1 year, really. But at the end of that loan term, the facility's finished, and it's not to say you couldn't draw against it again, but it's not. You would have to go through a loan process again, so it's not revolving. Documents required, pretty straightforward. It's probably about one of the easiest processes. There's a lot of low doc offerings there, i.e., low doc in this space means that you don't need to provide financials or any sort of supporting documents in that regard. Sometimes you need to provide bank statements, business bank statements, just so they can see that the business is actively trading. Sometimes you don't even need that. So, and it can be startup friendly. So My point about this type of product is the longer you leave it, the less options you have available. So if you have purchased equipment recently and you paid outright for it and you're thinking about doing this, don't wait. The longer you leave it, as I said before, some lenders have restrictions on the time frame. So the longer you leave it, the less options you have. And usually the less options you have when it comes to lending is the less competitive it's going to be, just because that competition is what, or that sort of number of options creates the competition, which drives the pricing and the rates down. The next one is online e-commerce and SaaS specific products. So, you know, there's a few parts here, and there aren't that many players that operate in this space, but there are some, and effectively they're designed for a very specific use case, and they understand those businesses very well. They are interest-free products, but they charge a fee to use the service. And more or less, you know, one of the most attractive part about these types of products is you don't always need a personal guarantee or a director's guarantee. It's one of the only loan products you can access where no guarantee is provided. And, you know, it's not a traditional loan product, hence why, you know, sort of not a lot of people know about it. It's not one that most brokers are going to recommend because not most brokers aren't going to have access. Not one that, you know, an accountant is probably even aware of. So it does pay to kind of do the research around what options are available to you. And you can raise, you know, quite a lot of money with these types of products. If you're considering rate for the reasons you want to, you know, dilute or raise equity is purely for marketing expenses, this could actually be a really good solution, because whilst they won't give it to you all at once, they will approve you for a facility limit. And if you continue to pay the facility limit, they'll gradually grow that limit. So you might get 50,000 the first time or 100,000 the first time you deal with them. And then if you're paying and you're getting that same ROI on your ads and things like that, they'll allow you to scale that, and they'll allow you to scale it quite rapidly until the point where they think they're seeing a diminishing return. And then they'll kind of say, that's the upper limit of what we will allow you to use. And your repayments there are a percentage of the revenue. So, you know, that makes it really easy to pay back. So if you have a, you know, seasonality in your business, as the seasonal nature kicks in, yeah, obviously the repayments will go down, which is another cool little aspect of this type of facility. Specific use case means this doesn't fit every loan purpose. There's only limited things that'll allow you to spend on the e-commerce and online space. And then SaaS specific products are, you know, very specific to a SaaS business. You need to be able to demonstrate software subscription revenue. And if you can do that, then obviously this is the right product for you. If not, then, you know, you may have to look somewhere else. Cons are these types of businesses usually can't do sole traders. They actually want, you know, a proprietary limited company. You know, kind of not necessarily something I agree with, but makes sense just the way that their businesses are structured. They need to see, you know, more than just the business needs to rely on more than just one person effectively. And unsuitable businesses for this type, obviously construction, trades, financial services, just like my business, and hospitality, transport, logistics. So there's some exclusions there, as you can see. The assessment process for these types of products, in particular, I'll talk about the e-commerce ones because they have a really unique strategy. They don't ask you for financials or anything like that. They ask to connect to your Shopify, Google Analytics, you know, or you know, the WooCommerce, or, you know, the equivalent of a Shopify, Facebook business account where you've got all your ad sets running, anywhere you receive income or where they can derive activity. So that's the best way to describe it. They're looking at your Instagram, your Google Analytics, your Stripe accounts, your PayPal accounts, anywhere where you're collecting money, and they're able to establish trends. You know, the trend, is it trending up, therefore increase the facility limit, or is it trending down, i.e., you know, be careful with the facility limit because they're no longer achieving an ROI on their spend, therefore they can, you know, dig themselves into a hole pretty quickly. You can also access the funds through a virtual debit card that you can connect to Google Ads accounts and things like that. You can also upload invoices to draw down funds. So one of the other benefits of these types of products is they typically have scale-up programs that help you get, cloud hosting credits and, other benefits that you may not, necessarily have access to. So we had one e-commerce client that was building selling a product, but then also building another service. And they were able to qualify for, I can't remember exactly how much, but it was something to the tune of somewhere between $50,000 and $100,000 of Azure hosting credits through Microsoft platform. And so that's probably going to see them not having to spend on hosting services for probably the next couple of years, which just takes a bit of the burden away. Cost of funds for this product, 8 out of 10. Ease of approval, 9 out of 10. Pretty straightforward. It's really easy to connect your accounts. And if you've ever given a marketing agency access to your Google Analytics or whatever, you just go in and permission them, and then they're sweet. Documents required, 10 out of 10, because there's next to nothing required. No director's guarantee required, and it's an unsecured facility that can be used for startups that have greater than 6 months, in the country trading. If you, again, here, they can charge higher fees. So typically for something like this, you would expect to pay a fee of about somewhere between 4 and 5%. If you're not careful, they can potentially try and charge more than that. So again, it just pays to have somebody in your corner. BNPL for business and corporate cards. I've kind of grouped these together only because there's not much to report here. Corporate cards, a lot of you be familiar with, your sort of Amex style charge card. There are other entrants in the market that have no international transaction fees. So if you are looking at your statement and you have a lot of online subscriptions, just in our business alone, we saved, by using one of these corporate cards. There's no interest, and it just gives you basically it's just a float. So it's a charge card. We saved about $1,000 in international transaction fee a month. Again, the cost of this is $25 a month or something like that. It's a membership. BNPL for business. Many have tried in this space. I'm not convinced it has been executed very well comparatively to the consumer space. Where we see a lot of it being used, companies like BizPay, is for recruitment invoices. So let's say you get an invoice from a recruiter, they do a placement for you, depending on the salary that person, that you need to hire was on. It could be, if you're hiring a senior software engineer and they command, $150,000 to $200,000 a year, as an example, then, the recruitment fees, depending on how much the recruiter charges, could be, $20,000 to $40,000. So breaking it up over 4 installments can take a bit of that pressure away. And typically they'll allow you to, the BizPay will allow you to pay it over, say, a 3 or 4 month period in monthly installments. Typically you're seeing smaller limits with the buy now, pay laters for business. And, with the kind of the corporate card style, you can get larger limits, but typically your turnover would need to be quite a bit, quite a high amount for you to get larger than that sort of 50K limit. Cost of funds for both of these, can be, it's a bit different to the afterpay model in the consumer space. So buy now, pay later for business isn't charging the merchant. Most of the time it's charging you. So that's why I put 8 out of 10. I haven't seen one where they only charge the merchant. I think that's usually associated with the consumer goods products and consumer goods buy now, pay laters. I haven't seen one that charges the merchant, but I wouldn't rule it out. If there's someone that charges the merchant and the merchant's prepared to wear the cost, then I would say cost of funds would be 10 there, 10 out of 10. Ease of approval, pretty straightforward process on both of them, digital for the most part, so 9 out of 10. Buy now, pay laters aren't revolving, but the corporate cards are. There's literally a revolving card, so it doesn't get more revolving than that. And both of them are unsecured, but they do not support startups. And obviously you've got one thing to watch there is you've got to make sure that if you do go down the path of a corporate card, that you're managing the limit responsibly, because if you do have a couple of tough months in a row, it's very hard to dig yourself out of that hole. It's no different to a credit card, I guess. But yeah, just be mindful of that. Probably the last one that maybe gets the least amount of airtime, I would say, would be venture loans. And this is all about positioning your business. So I'm going to use one ventures only because I've seen some people successfully fund through a venture loan and then go on. There are other players in the market. And to be clear, I'm not at all affiliated with One Ventures, but it's just what I've seen. And this is probably one of the least common products on this thing, but it's worth exploring if you are looking to position your business. So why would you want to do this, or why would you take this product? Pretty much to gain a relationship with potential investors. So if you did a pitch to a VC and maybe you weren't successful, you could ask them if they would consider doing a venture loan, which would be, you pay it back with X amount of interest, and it would mean that you're not giving up equity. But what it would do is allow you to stay close with them so that they can monitor your progress in your startup or in your scale up. It will also allow you to, I guess, build a runway to get investment. So maybe you're not DD ready, but you want to start that process. Might take 6 or 12 months for you to be in a position where you can, I guess, your business can support the DD process. So you can do that and, take out the loan and, let it fund your business for the next 6 to 12, 18 months, whatever is necessary, and then move into a DD process. It also gives you a chance to outperform and impress and seek a higher valuation. So if they're, kind of lowballing you and that's why you're not, taking them up on their offer, this is an opportunity for you to stay connected and outperform. And that's what I saw with this one startup, where, they were saying, we think it's worth X. They were kind of at a stalemate. They thought it was worth Y. This was a solution because they needed money and they were looking at, other options, but this ended up being a good option because it allowed them to stay connected. They didn't think that the forecasts were achievable. The forecast got achieved, and therefore they had no more excuses not to fund the business. Pricing does vary. Most of these kind of products are rate for risk, which, loan products in general, banks and lenders price according to risk. So, the higher the risk you are, the more expensive the loan product or facility is going to be. And the lower the risk, generally speaking, the lower the pricing and more competitive it's going to be. So the other con is they basically want you to ask for more than the standard sort of fintech type lenders, and we call it a DD light or mini DD, if you will. Reason is that they're understanding your business with a bit more detail so that they can have a view on whether they would consider investing in the future. They don't give out venture loans for businesses who aren't ones that they would later fund. That's the kind of the idea of it, is like, this is the trial period, if you will, of whether that VC is going to be a good fit. So yeah, cost of funds, not the most competitive out there. Ease of approval, 7 out of 10, it's not better than that. Revolving facility, potentially you could get that, but not typically. It's typically a term loan with an end date in mind. If you needed more time to kind of to hit the milestones or kick the goals, then you may want to extend that before going through and selling equity. And director guarantees are required here. They have both secured and unsecured options, more or less depending on whether what it's mostly dependent on the loan amount required and what level of risk the director has, how much industry experience, etc. But startup funding, their answer is yes. So they just need you to be at revenue generating stage for them to consider. So what I would say here is that in any DD process, you want to be doing reverse due diligence as well. So you want to make sure that this is someone that you could potentially have in your business as an investor in the future if you're going to go down that path. So a lot of information to take in there. You know, to summarize it as best as I possibly can, the best way to do it is ask questions, you know, to find the right solution. Ask yourself, one of the most important questions is, what problem am I actually trying to solve? Make sure you thought it through, build forecasts, understand exactly how you plan to spend the money. If you just get, you know, $500,000, $1 million into your bank account tomorrow, you know, you need to make sure that you've got a really smart plan on how you plan to spend that out. Because if you just start, you know, spending it on, you know, extravagant team dinners, and, you know, you'd be surprised how fast you can burn through the money. Another question that you need to ask is, do I need a short-term or a long-term facility? You know, if you choose the wrong one, it could make your situation worse. If you choose a short-term facility and you actually needed one that's going to be a bit longer term, you could actually be, you know, making the problem worse. You know, a shorter facility effectively is going to mean less interest, but a higher repayment. And that's what I'm talking about there. If you're not going to be able to support the repayments on a short-term facility, and it's going to create another separate cash flow squeeze, then you're best off choosing a slightly longer term facility that you make sure you have the option to pay off sooner if and when that suits. You also, I think, you know, anytime I'm looking at debt, I always, or even clients, one of the most common questions we ask our clients is, are you going to be able to leverage this debt? So is it just going to be a debt because, you know, you're trying to fix a problem and this is just the band-aid? Because if you haven't addressed, you know, profitability issues in your business, and this is just going to get you out of a cash flow hole, then, you know, there's that. Or is this the debt? And sometimes those band-aids are necessary. Don't get me wrong. We've all been there in business. It's not easy. But I think, you know, that requires a bit more, you need to be a bit more stringent on how you make decisions on those types of debts where you're just, you know, filling a hole, you know, an urgent need of cash. The better type of debt is where you have a plan to leverage the debt. So it might be, you know, you need to invest heavily on a new website that's going to help you generate more business, right? That's a no-brainer. How can you turn this $1 into many dollars? And if you've got a solution that includes, you know, or you've got a plan that includes leveraging this debt, then, you know, chances are it's a pretty good idea, if it's a sound plan. And of course, most importantly, you need to talk to your accountant or advisor. And the reason you need to do that is because, you know, no finance broker, myself included, or bank, actually really understands your business and your financial position and what your goals are and all those sorts of things. And so it's important. Anybody who's not telling you to have those conversations with a you know, a professional that understands the situation better probably doesn't have your best interests at heart. So yeah, those are the key takeaways. These are the questions you need to be asking. What problem am I trying to solve? Is it long or short-term facility required? Am I going to be able to leverage this debt, or is it, you know, fixing a problem? And, you know, what would my accountant or financial advisor say if I presented this to him with a business plan, etc. So I will hand back over. I'm going to stop sharing my screen so we can do a Q&A. I'd really love if any of you had any amount of questions. No such thing as a silly one. Really just here to help our community and make sure that people have access to the right information. If there's anything I need to follow up on for you, I absolutely will. So yeah, I'll see everybody's beautiful faces again. So wait, no questions in the chat just yet, but has anyone got any questions at all? Any? Yeah, can you tell us something about your business? Yeah, absolutely. So LoanOptions.ai, maybe I'll speak about how I started it and why I started it. So I worked in asset finance, which is effectively everything gets bundled into asset finance that is non-property lending. So everything but property. essentially. So equipment, cars, boats, motorbikes, business lending, lines of credit, personal loans, unsecured, all that kind of stuff. And I was working in the industry as an employee, and I was just noticing that of every industry that gets slack, of every industry that gets criticized, including the construction industry, we were the least transparent, and it really bothered me. And so I'll give you an example. If you engage a tradie to come to your house and fix an issue at your house or do a renovation, they give you a quote. You then decide if you want to proceed, and if you're happy with the quote, you accept. In finance, and you can do this even until today, you can walk into a dealership if you're buying a car, or you can talk to a finance broker and you say to them, okay, what's the interest rate for this product? And they'll dance around the question and tell you, we need to know more about you before we can give you a figure, and all this kind of stuff. And it's partially true, but it's certainly exaggerated. That they could give you a rate, or they could at the very least give you a range until they know more about you. So what I wanted to do was remove that lack of transparency. And so what I did was I started working on a matching tool, a credit matching tool, so that when a customer came to us, within 30 seconds or less, they could actually put in some information and have access to the best available loan results, and all the information about those products. So what it does is, LoanOptions.ai is a platform where the client can enter some information like, I want a car loan for personal use, for $50,000 over 5 years, as an example, or I want an equipment loan for 5 years, blah, blah, blah. They enter some information, and it makes a range of assumptions based on historical data. And as they're entering in their application and their application information, the more information they provide, the more accurate the results get. So it's using AI and all of our historical data to actually accurately match them with the right lender. And so, easier than I can explain, I can just show everybody really quickly. You should be able to see my screen now, but this is our website, and it's kind of got all the information about what we do and how we do it. But if someone was to select, I want a car loan for personal use for $50,000 over 5 years, it takes a couple of seconds, and then in real time presents results. Now they can change it and say, I want to borrow $20,000 or $50,000 or $80,000 or whatever it might be. They can select their car and say, I know what car I want. I'm buying from a dealership, and they can search the vehicle, or they can say, I'm still looking, I just want a pre-approval. And so the more information they provide, the more accurate these results are getting. So by the end of it, when this AI match reaches the end, the result they're seeing there is more than likely going to be the result that they end up with. Now, don't get me wrong. Sometimes customers put in the wrong information, or they misinterpreted the question, or whatever it might be. So it can never be 100% accurate, but it's going to be very, very accurate to the tune of 80 to 90%. And then our team on the other end, a team of licensed, accredited, experienced brokers, are there to concierge the client all the way through to actually getting the funds in their account. So this type of technology that allows the client to apply completely online, including uploading their supporting documents and signing their consent forms, has enabled us to deliver really fast outcomes. So our record currently that currently stands is from first inquiry and to money in the client's account, and this was for a personal loan for $30,000-ish, was 36 minutes. So client was on their lunch break, input their information, got a call from our team, verified all the information, submitted it to a lender, it got approved, it got settled, and money transferred into the client's account. All end to end was 36 minutes. So, so that's a little bit about our business, and we actually built this technology so that it could benefit everybody. So we made this technology available to partners and other people in the industry. We didn't just keep it for ourselves. People can license it if they want to, and get the benefit of it. And obviously their customers can get the benefit of it as well. So, no problem, Warren. Thank you for the question and showing interest. If you want to see more about it, we can connect separately, and I'll happily tell you more. Anyone got any questions about any of the products or anything that you've heard in the market that you want to verify or validate? All good. If there's any questions that maybe aren't fit for a public forum like this, I'm sure you'll have my details. Happy to connect on Boa. Send me a DM. I can jump on a separate call with you if you've got some questions or concerns about any of it. Really appreciate everyone's time. Today I'll hand back over to Lauren and the team. And thank you to everybody for organising this today. I'll hand back over now.
So thanks so much for attending, everyone, today. Be sure to connect with Julian in the FinTech community and get set to attend any of his upcoming networking and educational events. We'll see you all again next time.